Welcome back to the channel, everyone. In this video, I'll be analysing Salesforce, ticker symbol CRM. I recently ran a poll on the community tab for which stock to do first, and the winner was Salesforce. So firstly, I will give the answer you are all looking for, and that is yes, Salesforce is currently under or around its intrinsic value, based off a 5-year valuation that I've done and a discount rate that's as high as 15%. Now, the stock is even more undervalued if you're okay with a lower discount rate that reflects, say, the return of the S&P over time. So based off an 11% discount rate, CRM is actually 25% undervalued. However, maybe an easier way to look at it is you can expect a 2x from the current price in the next 5 years, as my price target for 2025 is around $466 per share, a great return for holding a blue chip company like Salesforce. Now, of course, this only works out if my projections are correct. So we'll look at those in a moment, but just want to touch on the discount rate. I like a 15% discount rate, to be honest with you. One, it reflects the minimum target annual rate of return from any investment that I have, but also eliminates stocks that are likely to have average returns. Now, I see a lot of YouTube investors value stocks using, say, a 10% or even 8% discount rate, which really makes a lot of companies seem like good value. But as viewers, you really need to understand the power of that discount rate and which it carries in the intrinsic valuation. Do you really think that, say, Warren Buffett or any other, high return investor used an 8 to 9% weighted average cost of capital as their discount rate to value a stock? No. It's a sell-side analyst thing to grab attention on a stock, or even actually an academic way of determining the fair value, which is the correct way to do it, but we're not academics, we're investors. I've also done a 10-year DCF, which actually values CRM even higher due to the long runway for growth that they have. But now I've given you the answer, let me show you why Salesforce is undervalued in my opinion, what the growth rates and assumptions I have used in this valuation are, and what the realistic runway for growth looks like. In case you didn't know, Salesforce is largely regarded as the world's best CRM platform, and CRM stands for Customer Relationship Management. So the CRM system helps manage customer data, supports sales and marketing, and delivers actionable insights to stored customer data, as well as facilitating stuff like team communication. Salesforce offers cloud-based CRM systems, or a cloud-based CRM system, which offers its users complete mobility and access to an ecosystem of products through offering subscription-based software or software as a service. The founder and CEO is Mark Benioff. Similar to one of the other companies, or some of the other companies we've covered, he is an owner-operator, which we love to see. And on average, the companies with owner-operators have always produced the best results. So it's definitely a positive for me. He founded the company in 1999 and has guided it since to be the leading business in its field, as well as one of the most impressive companies in the world in general. Started his career in software at Oracle and actually had Larry Ellison as his mentor. So firstly, let's just look at the impressive growth they've achieved so far. So revenue has been growing at a compound annual growth rate of around 25% over the past 5 years, which is outstanding growth. Gross profit, they're very, very profitable business when you look at their cost of revenue. So gross margins are 75%, which is huge. And it leaves a lot of room for high bottom line profit margins as well, and free cash flow, which we'll likely see when the reinvestment, back into the growth tapers off. And we've already seen how profitable this type of business is with the likes of Microsoft, Adobe, Oracle, and SAP, etc. One thing to point out as well, and I always like to point this out with growing companies, they spend a huge amount on marketing and sales and R&D, around 62% of their revenue, as you can see. And again, this leaves a lot of room for improved margins when these reinvestments into the business begin to taper off. And as we looked at with Amazon, these costs, are almost like investments for growth rather than actual costs, although technically, they are expenses. The real cost that we don't like to see really is G&A, general and administrative expenses. But they only spend 10% of revenue on G&A, which demonstrates really the efficiency and capital-light business model that Salesforce has. EBITDA, the margin's currently sitting around 18%, but as we just looked at, you wouldn't argue this couldn't reach something like 30% in the future, which is closer to the market average or industry competition that they have. Another nice metric to look at, EBITDA and earnings have been growing faster than revenue. So that means they're getting more profitable with scale, and that trend will likely continue. And we love to see that, companies benefiting from economies of scale. Free cash flow, they are free cash flow generative and quite constant in their margin. So we will be using free cash flow as a percentage of EBITDA to forecast the future free cash flow. And, we've done a similar thing with Amazon and some other companies as well. As you can see, it follows a fairly consistent trend, although dipped this year. But, they are constantly free cash flow generative, which is definitely a tick of the box in that sense. And then some additional info down here that I always like to add. Firstly, I just want to talk about shares outstanding. So shares outstanding have been growing, at quite a quick rate. I think it's around 5% on a 5-year basis, which I definitely don't like to see. And it is, one of my main concerns with Salesforce going into the future, to be honest with you. They do, dilute shareholders, and I don't like to see it, and especially, not at a high rate like this. But as you know, they do tend to acquire a lot of companies, are very active in M&A, and the majority of the time they pay partially in shares, which, it's difficult for investors to measure whether they are adding value with this or destroying value. I wouldn't like to see them take on 28 billion of debt and then buy Slack or something like that. So, it's a difficult one to judge, but I definitely don't like to see it, and I'd hope that it stays flat going into the future as they get bigger and are producing, high amounts of free cash flow. Okay, now let's look at some of my forecasted growth rates, and we can get an idea of how realistic this valuation for Salesforce looks. Before we jump back into the valuation and look at my forecast from a qualitative perspective, here are the catalysts for growth I see. So first of all, COVID world speeding up mass digital transformation and migration. And Benioff talks about this quite a lot in his interviews, saying that this is the new normal and they're going to see the benefits of it. Secondly, spending on CRM software for businesses is forecasted to double in the next 5 years, and that's about 20% compound annual growth rate. Acquisitions of new companies that complement their offering will accelerate growth and increase their total addressable market. So as we can see, they have been very active in acquisitions. They do tend to spend a lot of, or pay, quite high amounts for these companies. But from my understanding, they see it as an opportunity to complement their current offering and expand that out. And they feel that once they plug these into the Salesforce system, they can extract new value out of these businesses, and they can cut costs, they can accelerate growth, introduce them to new customers that they wouldn't have had before. Next, larger total addressable market being business software, and that's expected to grow at about 11% compound annual growth rate to 2025. And this is a much larger market. Think of the likes of Microsoft they're competing with in this total addressable market. But they definitely want to be a part of that, not just a CRM software company. You can see the ambition in the acquisitions and the way in which Mark Benioff talks about the future of Salesforce. Lastly, the ecosystem of products and services on one platform and best-in-class SaaS will help Salesforce continue to steal market share from their competition, which they've already been doing, quite rapidly over the past 3 to 5 years. And I think that will continue to happen. If we look at the industry stats, so like that 20% compound annual growth rate for CRM software, and then business software in general being 11%, that's significant tailwinds. And I think if we feel they can come out a winner of this, which I believe they will, then we could expect to see somewhere in the region of 20 plus percent growth for Salesforce for the next 3 to 5 years. And this is sort of in line with the targets that they've set themselves at their Dreamforce conferences that they hold. Okay, here's my 5-year forecast then for Salesforce. As you can see on the top line, I've gone with a 20% growth rate like I just spoke about. And really that aligns with the fact that I feel they'll get to 50 billion in revenue in 2025, which is about a 10% capture of their current addressable market, which is business and software services. Also, the fact that Benioff himself set a target of 35 billion in 2023 for revenue and a growth rate of above 25%. And a growth rate of around 20 to 25%. So I think they'll be able to do that. And again, that 50 billion falls in line with a 10% capture of their total addressable market, which I think they're more than capable of considering the tailwinds behind them and the product that they have. When we start to look at EBITDA, so as we mentioned, there was a lot of room for improvement in the margins, through R&D and sales and marketing tapering off slightly, and also that efficiencies, with the economies of scale and things like that, them getting more profitable as they get bigger. So I think we'll see a trend like we saw in the previous years where they went from around 15-16% to nearly 19% in their EBITDA margin. So I've gone with them ending at about 23% in 2025, which is more than doable considering we saw their only real static costs are the G&A at 10% of revenue and the cost of revenue at 25%, which is 35% of revenues. That leaves 65%, for reinvestment in things like R&D and sales and marketing, which they will need, even at this point in 2025, they will need to spend quite a bit on that. But whether it's 40 or 50% of revenue, I don't know. But there's a lot of room for improvement. So I've gone with 23%, and actually in my mind, I feel that it's fairly conservative. Net income we're not going to worry about too much, but that is again scaling upwards as well, but it's not a huge part of our valuation. Free cash flow is going to be a percentage of EBITDA, so I've gone with 114%, which is the average over the past 5 years. Free cash flow has mirrored EBITDA quite consistently, except for last year where in the current year, where it's been a little bit below EBITDA, but I think it will follow that trend into the future. Shares outstanding, I've got remaining flat, but there is the possibility of dilution, as we saw in the previous 5 years, but I hope that's not the case. I'll show you how maybe a 2% dilution each year will affect the share price near or towards the end of the video. Cash and equivalents, I've got them growing at 7.5% and 5% respectively. Doesn't make much of a difference in the valuation, and then that gets us to our terminal value. I'll just zoom in a little bit, which, as you know, the terminal value usually makes up the largest portion of the present value. So it's important we spend a bit of time on this. I've gone with two forms of TV multiples or terminal values. I've got an EV to EBITDA multiple, which is up here, 35 times, and a free cash flow yield of 2.5%, which I think both are reasonable, but they measure it in a different way. In terms of the EV to EBITDA multiple, if we look at some of the relative valuations, we've got the industry as a whole, average is about 35 times, and I think they should be sold at a premium to the market or their industry in general. They are best in class, so we have to think about that. Some of the older companies, they have lower valuations, but growth is pretty stagnant for these companies. I don't expect Salesforce to be in a similar position anytime soon. If we look at Adobe and Intuit, even Microsoft to an extent, some more similar companies in the industry where the growth outlook is still quite high, and that's similar to Salesforce. So if we take an average excluding Oracle and SAP, again, we get 35. So 35 was what I went with for our multiple in this valuation. And actually, if we look at it on a PEG basis, then it's about 1.4 compared to the growth rate of 25% that earnings will see in 2024 to 2025. And 1.4, that's actually quite a cheap PEG ratio nowadays. So that gives us a level of accuracy in our EBITDA multiple of how high or low we've gone. Free cash flow yield of 2.5%. That's a similar way of thinking about a interest rate on a bond or interest rate on an investment, and 2.5%, but that 2.5% is going to be growing at 25%, for the foreseeable future. Earnings have grown at that rate. So that 2.5% pretty soon will be 5%, then be 10%. So 2.5% is always not a bad base to go off if you know the growth rate is going to be above 20%. So that was my thought process on these two TV multiples. Anyway, we average it and we get 437 billion as our terminal value in the future as an average, which gives us that expected return of 2 times over the 5-year period. And moving on to the intrinsic value part, so we've got our stream of cash flows there. We've got the 5 years of free cash flow we'll receive or reinvested back into the business, and then our terminal value at the end in year 5 or year 6. This is basically calculating it as. And on a 15% discount rate, which is mine, it's still saying that we're slightly undervalued, only by 2%, but we're there or thereabouts. If you're happy with a 15% return, technically it's a good buy for you at this price. If we knock it down to 11% or something like that, more of a S&P weighted discount rate, then it's 25% undervalued. So you could say it's cheaper than the market at the moment, which is a good sign. One thing I did say I'd show you is if they do continue to dilute shareholders, say 2% per year, it's unlikely they'll go at 2% per year now, they're getting larger, but let's say they do, then that does bring our expected return down slightly. The intrinsic value comes down slightly as well. And if we're using our 15% discount rate, actually says based off of that would be 7% overvalued. So it's not a complete certain bet. I will say there are some variables, as always, that will go into it. But that is just one of my concerns to do with the increase in shares outstanding. Hopefully they stay flat though. Okay, and lastly, here is my 10-year valuation. And this might be beneficial for some people just because the story for Salesforce isn't finished in 2025. They will likely grow further into the future. So this 10-year valuation model actually shows them as even more undervalued than the 5-year one, just because we do have a longer period of sustained growth. Now, the main differences in this valuation, I'll just zoom out slightly, is in the revenue and EBITDA. So we've got revenue still growing past 2025, but slowing as time goes on, and we finish on 10% in 2030. It's around a 15% annual growth rate beyond 2025 that I've gone with. The EBITDA margins start to creep up nearer to 30%, which if we go back here, we can see is near the industry norm. Some of their relative companies I've got listed here, the average is 36%. So we're leaving a little bit of upside in the margins, if you ask me. I think they could be more profitable than that. They've got a very capital light business model, and like we saw earlier in the video, most of their spending is on sales and marketing and R&D. So, but I've gone with it just creeping up at 1% per year like we've seen it do in the past and like we've gone with on the 5-year. I've got my multiples have come down a little bit as well. Gone down to 30 on the EV to EBITDA, which still might be a little bit steep, but I've gone with a 3% free cash flow yield as well, which is more of a reasonable yield to be buying a stock at. But it's warranted because growth is slowing, although earnings growth is still quite good just because the margins are improving with scale. Anyway, off of these estimates, if they can turn this into a reality, we've got an intrinsic value for them now at $250 billion or $260 per share, which means based off of that, it's about 20% undervalued at the moment, even off a 15% discount rate. Again, if we put that down to 11, then it's even more undervalued, which actually might say something about the assumptions. But go with 15% for now, 20% undervalued, not a bad stock to be buying in my opinion. Of course, this wasn't exactly a deep dive into Salesforce and the business itself, although we did do some analysis on the total addressable market and the catalysts for growth. Based off of the model, it looks like it could be a buy right now if you're willing to hold, for the long term, and you believe in the growth projections that I've put forward here. I will get to putting a video out on the other stocks that I run in the poll. Whichever came second will probably be done next. But if you enjoyed the video, be sure to leave a like, comment, let me know what you think of Salesforce and the valuation. Do you think it's undervalued? Do you think it's not? Will you be buying? If you're new around here, subscribe, click the notification bell, and you will be notified of when the next one goes up. But until next time, good luck with your investments.